Hello everyone. Today I am going to start a new topic related with ratio analysis, liquidity ratio. Meaning of liquidity ratio. Liquidity ratio are calculated to determine the short-term solvency of the business. Analysis of current position of liquid funds determine the ability of the business to pay the amount due as per commitment to stakeholders. Included in this category are current ratio, liquid assets ratio, and cash fund ratio. Current ratio. Ratio of current assets to current liability is known as current ratio. It is expressed as follows. Current ratio is equal to current assets divided by current liabilities. Current assets include cash in hand, bank balance, debtors, bills payable, stock of goods, prepaid expenses, marketable securities, etc. Long-term advances to employee should be ignored. Current liabilities include creditors, bills payable, outstanding expenses, etc. Provision for taxation should be taken net of advance tax. Cash credit, bank overdraft, short-term loans, etc. shown under the head secured loan or unsecured loan should be taken as part of current liabilities. Similarly, gratuity, pension provision may be taken as long-term liabilities. Standard norm for current ratio as per recommendation of the core committee is 1.33 to 1. It is calculated to test the short-term solvency of a business and its ability to meet its short-term commitment. Next, quick assets ratio. It is the ratio of quick or liquid assets to current liabilities. It is calculated to serve as a supplementary check on liquidity position of the business and is therefore also known as acid test ratio. It basically ignores those current assets which cannot be easily converted into cash, such as closing stock, prepaid expenses, etc. As if considers only liquid current asset, it is also referred to as liquid ratio. The logic behind exclusion of closing stock is that it is the least liquid current assets and its valuation involves judgment and estimation. Because of exclusion of non-liquid current assets, it is considered better than current ratio as a measure of liquidity position of the business. Standard for liquid ratio is 1:1. Next, absolute current absolute cash ratio. To know the availability of most liquid assets, that is cash, instead of total liquid assets in a business, cash position ratio are calculated. Availability of cash may be studied in relation to current liabilities. Analysis of cash position in relation to current liabilities is done by calculation of absolute cash ratio. It is calculated as follows. absolute cash ratio equal to cash resources or funds divided by current liabilities. Cash position may also be studied in relation to total assets or average daily cash expenditure. The ratio calculated for this purpose are as given below. Cash to total assets ratio equal to cash resources by total assets. Cash interval equal to average cash resources divided by average daily cash expenditure. Cash resources or funds include cash on hand, demand deposit with bank and quoted non-trade in investment which can be easily marketed. These investments are taken at their market value. Current liabilities are included those provision against which liability may arise in the near future, such as provision for taxation, less advance tax, provision for proposed dividend, etc. Total assets are excluding fixed assets such as discount on issue of shares, deferred advertisement expenditure, etc. Cash expenditure includes advance tax payment and all cash expenses which are charged to profit and loss account and excludes non-cash expenses such as depreciation, intangible written off, profit and loss on sale of assets, provision for taxation, etc. To arrive at average daily cash expenditure, total of cash expenses and advance tax is divided by number of days in a year. It is calculated as follows: average daily cash expenditure equal to cash expenses plus advance tax divided by 365. Thank you.